The housing market is on the brink of a crisis that could be far worse than what we experienced in 2008. This week, DR Horton, America's largest home builder, revealed numbers that wiped billions off their market value in just one day. Today, I'm taking you inside what may be the most significant housing market warning of the last decade. The story isn't simply in the headline figures, it's in the overlooked details that almost no major outlet is covering. On Tuesday morning, during a 45-minute earnings call, DR Horton CEO David Auld disclosed that new home orders in key markets have plunged by 38%. What's even more startling is the company's desperate strategy to move its inventory, offering unprecedented incentives across every price point, from starter homes to luxury residences. When a company with a 44-year legacy takes such drastic measures, you know something isn't right. DR Horton isn't just any builder. They've built one out of every 10 homes in the country. Last year alone, they delivered over 82,000 homes and generated more than $33 billion in revenue. When a market titan starts sounding alarm bells, it signals that the entire housing landscape is shifting in ways we must understand. Even more alarming is the surge in cancellations. Over 27% of buyers are walking away from contracts despite the company offering mortgage rate buydowns, valued at around $40,000 per home. The market reacted instantly. DR Horton's stock dropped 11% within hours, and the whole homebuilder sector lost billions in market value, with trading volumes spiking and several analysts issuing downgrade warnings in just the past 30 days alone. New home inventory has surged 97% in their primary markets. Price reductions are appearing on 42% of new listings. Construction companies have laid off 27,000 workers. Major land acquisitions have been halted across the Sun Belt. This isn't an isolated incident. In just the past 30 days, new home inventory in key markets has surged by 97%. Builders are pausing land acquisitions, and construction companies are laying off thousands of workers. Such dramatic changes mirror warning signs seen as early as 2007, but the speed and scale now suggest an even deeper downturn could be imminent. Let's break it down regionally. In Texas, the state provides a preview of the nationwide shift. In Dallas, where DR Horton's inventory is heavy, new listings have surged by 112% compared to last year, and median prices have dropped 5.2% in just 90 days. A veteran Dallas agent recently said, "I've never seen builders this desperate. They're offering incentives I didn't even know existed." In Austin, inventory has skyrocketed by 143%. Homes that once sold within 48 hours now linger on the market for an average of 97 days. And in Houston, builder cancellations have spiked by 47% across all price segments, from affordable homes to high-end properties. Florida is echoing these unsettling trends. In Tampa, new home inventory has climbed by 78%, with builders fiercely competing by offering enormous incentives. Some companies are even locking in mortgage rates for 30 years at 4.99%, effectively shouldering hundreds of thousands in rate buydown costs per home. In Orlando, price reductions have become standard. 42% of listings now show cuts averaging $42,000. In Jacksonville, builders are offering incentives that nearly wipe out their profit margins just to clear inventory. This hyper-aggressive incentive environment is unprecedented in recent real estate history. Meanwhile, institutional investors, once active players, are disappearing. In Atlanta, for instance, where investors once comprised 32% of home purchases, large buyers have virtually halted their activity, with investor transactions down by 68% year over year. This isn't happening in isolated pockets. The decline is synchronized across major markets. The rapid turnaround, reminiscent of late 2007, suggests that what we're witnessing now could be even more severe than past downturns. Builders are now rolling out incentive packages that border on the unbelievable. DR Horton is offering a 3% mortgage rate buydown, costing about $42,000 per average home, plus an extra $25,000 in closing cost assistance and up to $75,000 in premium lot discounts. In Phoenix, one sales office is even throwing in luxury car leases for buyers who close within 30 days. Lennar, America's second-largest builder, has launched a whatever-it-takes program that could exceed $100,000 per home in rate buy-down costs over 30 years. In some cases, total incentive packages top $200,000 for million-dollar properties. Essentially, builders are sacrificing almost every cent of their profit margins just to avoid the burden of unsold inventory. Another disturbing trend is the rise of what industry insiders call shadow inventory, homes that are nearly complete but deliberately left unfinished so they aren't counted as available inventory. Estimates suggest there could be over 100,000 such homes nationwide. This hidden stock is creating a domino effect. Major suppliers report that lumber orders have fallen 42% year over year, window manufacturers have seen a 35% drop, and appliance as well as flooring orders are declining sharply. The entire construction supply chain is under intense pressure. Builders are also burdened with vast land holdings purchased at peak prices in 2021 and 2022. DR Horton, for example, carries over $9 billion in land and development costs. As home prices fall, these once valuable assets are depreciating rapidly. In Las Vegas, a model home sold for $680,000 in September was relisted next door for $589,000, instantly creating negative equity for the earlier buyer. Every discounted new sale is dragging down the resale market too, as appraisers are forced to use these heavily incentivized deals as comparables, further eroding home values and shaking buyer confidence. With the relentless price cuts, buyers are increasingly adopting a wait-and-see approach, expecting prices to drop even further. This psychology fuels a vicious cycle. As builders offer larger incentives, buyers hold off, which forces further inventory buildup, leading to even steeper price cuts. Real estate agents now report that over 70% of their clients are explicitly waiting for lower prices, and many lenders are growing cautious, requiring additional appraisals and even offering price drop protection on new loans. While the 2008 crisis was fueled by subprime lending and mortgage defaults, today's challenges stem from an affordability crisis compounded by a massive inventory glut. Back then, inventory issues built slowly over nearly 2 years. Now, a 97% surge has occurred in just 9 months. And while the Federal Reserve had room to lower rates in 2008, current inflation concerns leave policymakers with little maneuvering space. The market is not collapsing overnight. Instead, we're witnessing a controlled demolition as builders gradually lower prices to lure back buyers. Now I want to hear from you. What are you observing in your local market? Are builders offering these unprecedented incentives? Are home prices dropping rapidly? Share your thoughts in the comments below. Your insights help shape our content. If you found this analysis useful, please hit the like button, subscribe to our channel, and ring the notification bell so you never miss an update on this rapidly evolving market. Stay informed, stay prepared, and thank you for watching.